Hello everyone, George DeSantis here with a look at the market for the week ending Friday, March 6, 2020. As those of you who get the email know, I did um, a special look at the market yesterday, I think it was, on Saturday. And in that case, I simply looked at some individual stocks that I saw trending up and meeting certain criteria for being in an uptrend. But this now will be the regular look at the market, in which case I take a look at the general market using the S&P 500 particularly, and then if we have time, we take a look at some individual stocks. But before we do anything else, the disclaimer is important. So take a look at it. Make sure you understand that I'm not trying to give individual advice here because I couldn't possibly do that. You need to consult a professional investment advisor if you need that sort of advice. Let's begin by taking a look at the weekly chart of the S&P 500. So this is a weekly chart of the S&P 500 from TC 2000. Excuse me. Well, as usual, we take a look at the moving averages. The 4 exponential moving average is still above the 9, the red line. The yellow line is the 4, the 9 is the red, and the green is the 30-day weighted moving average. Well, in this case, 30-week moving average. So we can see that we are in this, we started a downtrend here. Last week we had a bad week, and 2 weeks ago rather, we had a bad week. And last week we had this sort of dragonfly candlestick. Looks like a dragonfly, doesn't it? And they call it a dragonfly. And to some extent, I think we could make an argument that it's also part of a bullish harami where the body of this candle is totally engulfed by the body of the previous candle. So for those of us who are anticipating an upward move in the market, this is a little encouraging. And if it weren't for the coronavirus and its impact, or possible impact at least, on the economy and the markets, one would say, hey, this is a nice looking indication here. You have a bullish harami. And so we might start nibbling. But given the virus and its effects, we still have to be somewhat cautious. I think that's a judicious way of looking at it. And for other reasons, you see how this is broken down here. Parabolic is above the most recent bars, last 2 weeks. So we are saying we're in a downtrend according to parabolic, because the parabolic is a parabolic stop and reverse indicator. So it's like stop what you're doing, stop the uptrend, begin the downtrend, and that's what we got. Now, MACD histogram fell below the zero line, so one will have to say that the bears are in charge here. And also notice that one of my favorites anyway, Williams percentile, dropped below the minus 50 or magenta line, and also the sum of the rate of change indicator dropped below the 4% line. So all in all, this is at least the majority of the chart indicates that it's a bearish chart, with some glimmer of hope here with this dragonfly and also the bullish harami. Let's look at a daily chart. So here is a daily chart of the S&P 500 on the same TC 2000 software. We can see up here, when we look at the moving averages, you can see that when that 4 crossed over the 9, it was time to at least get cautious, if not get the hell out. And so we had this, what is considered a fairly significant pullback. And right now, we are seeing that the 4 is below the 9, 9 below the 30, 30 is below the 50-day moving average. So it's all in a downtrend. Now, we can say, perhaps we can draw a conclusion that we're in a trading range here at this time, because we had this drawdown and then the market went up a bit. Parabolic went below these 3 bars here. But then on Friday, we got this bar, which, parabolic is once again above the most recent bar. So parabolic is saying, on the daily chart, we now have a downtrend again. However, as we all know, if you were watching the market on Friday, the market tended to reject these low prices here as it did here. The candlestick, you could see the shadow is pretty long, it's at least twice the width of the body of a candle. So what we're looking at here is we still are in a downtrend on the daily chart. And remember, when it came down all this way here and we hit 100% retracement, this Fibonacci retracement of 100%, so we gave back everything we gained from October, if you didn't sell anything, we gave it all back 100%. And then we rallied, but we found some resistance up here, right here at the 9 EMA. So at that time I said, look, I don't think we're going to get a V-shaped rally and recovery from here. We'll likely put in a double bottom. Now one can wonder if we are putting in that double bottom. We hit a bottom, we rallied, we're coming back down. Well, it's possible that we did put a double bottom in, and that we rally from here. And given the fact that we have that bullish Harami on the other side, on the weekly chart, if we didn't have this virus to deal with, I would be a little more bullish here. But look at the other indicators. You see MACD is still below the zero line. That means even on the daily chart, bears are still in charge. And of course, the Williams percentile indicator broke down below the magenta line, or -50, and it's still there. So we need to see this take a position above the magenta line in order to get more bullish about this market and begin to nibble at it, not to go back into it full hog, and bet the farm. Look at the sum of the rate of change indicator, also below the 4% line. So caution, I think caution is in order. I only own a couple of stocks here, as I mentioned to you. I own some Zoom, I own some Teladoc, and the TMF Treasury bill ETF, leverage ETF. But let's take a look at some of the charts. So I thought it would be interesting to look at the S&P on the Ishimoku cloud chart, and something very interesting here. We were saying that we got this regression all the way back to the 100% retracement here, and now we seem to have this dragonfly candlestick and a bullish Harami. And notice what we're seeing is that on the weekly chart, the candlesticks remain just above the cloud. So can the bulls have a little more optimism here? The volume also was pretty good last week, so this is a weekly chart. We'll keep this in mind. It's still above the cloud, and that might give the bulls a little encouragement. Let's look at the daily chart. Now, of course, the daily chart presents a different picture. You can see how we fell below the cloud, and we are now sort of putting in a double bottom. And hey, who knows? Maybe this put this together with what we saw on the weekly chart. We have a double bottom. We start rallying from here. The weekly chart is above the cloud, and we go higher. Who knows? One never knows. Do one. Good old fat swallow. Let's take a look at some other things. Now here's a StockCharts.com chart showing the new high, new low spread, a 5-day average. And remember that I mentioned to you that Alex pointed out during the 2018 pullback that it dropped all the way down below -4,000. And he said at the time, if it crosses back above, we're likely to see a nice rally. Well, if for those who are looking for some encouragement, the bulls again, you have a little bit of encouragement here, because if Alex is correct and it happens again, it means that we are now breaking above that -4,000 line again, and maybe we get some upside reaction here. We'll see. Here's that chart of the percentage of stocks in the S&P 100 above their 200-day moving average. You can see that what happened in December of 18, November, December, is we took this big drop here, and then we started moving up again, somewhat similar to what we saw on the new high, new low index. Who knows? I don't know if this is any indication that that we're going to start going back up from here, because we saw what happened here, you know. This was a V-shaped recovery, though. I don't know if you're going to get one here, but it's encouraging. Let's put it that way. Now on Shake Analytics, you can see the SPY, which is of course, as you know, the ETF of the S&P, and you can see it is really very oversold. It is really very oversold, and although you know you can see there is some nibbling, some buying here, and we are seeing this double bottom, possible double bottom here. Doesn't mean we're definitely going to go higher from here, but you know, and just break out at a recovery. But this is encouraging. We might find some support here. The market is very oversold. Now, of course, this is all you know, technical, but what about the virus? How does it affect the market in general? Is the supply chain from China so devastating that devastatingly affected that we just can't recover from here very soon? I don't know. All I'm looking at is charts. We can take a look at a few individual stocks on Shaken since we have some time left. Um, we'll start off with looking at Microsoft. How's that? You see, Microsoft, we rode it all the way up from October, rode this nice gravy train here, and now it's terribly oversold. Of course, the money flow dropped like heck, but it seems to be coming back up. We seem to be getting some nibbling here, some buying coming in. It's very oversold now. So if you never own Microsoft and you're a bit of a gambler and don't think it's going to go much lower, this is probably as good a time to buy some. Um, I'm going to be looking to buy it back, but not necessarily at this time. What about Apple? Take a look at Apple on Shaken. We get a very similar chart. It was very oversold. Now it's in neutral territory, but you can see that it outperforms the rest of the market. Continues to do so even during this correction. So Apple is another one. I would buy it back, but maybe not right here. XLK, you know, I like that. It has a very similar chart. Look at this. Very sort of double bottom-ish, and now it's oversold. So if you owned it, may not be a good time. If you didn't sell it and wanted to avoid this drop, it wouldn't be a good time to sell it now, I don't think. But if you didn't own it, this is probably a good time to start taking a look. And if you want to own 100 shares, you might buy 20 shares or 40 shares and then keep adding to it. Don't put it all in at one time, you know. Let's see, what else am I looking at? How about this INMD, InMode? Um, lost some money on the way. I lost some money here, I lost some money here. I'm not buying it again right now. I want to see it break above this line here if I'm looking at this chart, and I want to see some other things on the TC2000 as well. I like the company, I like the idea, the business, but ain't for me right now. I'll miss the bottom. Here's one that I bought probably about a week and a half ago, Teladoc, and you can see it's still very oversold and ticking up. This is that healthcare technology stock, which means you can call your doctor on the phone and have a consult. And I believe that many insurance companies will pay for it now. They just passed a law, I believe. And let's take a look at Zoom. Zoom is that stock that many people have bought, including myself, but it may be overbought here. Although you're getting mixed signals, overbought here, oversold here. So I'm going to hold it for a while until I see if it starts pulling back, I'll get rid of it. But right now I'm still holding it. And let's take a look at that third. And here's the leveraged bond fund. You know, I bought it. I'm up. I participated in most of this run here. So, but now it's overbought. You see, it's way up here. So I might just take the gain and get going. But anyway, have a good weekend. I hope you had a good weekend. It's Sunday afternoon. We'll try and do this again next weekend. Good luck with trading.